Thanks for checking out this video. Before we start, I am not a financial advisor and none of this should be considered financial advice. This tool is for educational and personal planning purposes only. It does not constitute financial, tax, legal or investment advice. All projections are estimates based on the values that you enter and are not guaranteed. In the previous video, we looked at some of the new tools available in the Drawdown Strategies area that can help give you more confidence in the plan that you create using the Retirement Income Planner. In this video, I want to look in more detail at how those tools can all be used together to come up with your own plan that gives you an extremely high amount of confidence. Most retirement planning advice gives you one number, a withdrawal rate, a savings target, a magic percentage. But what if your plan looks solid by one measure but shaky by another? In this video, I'm going to walk you through a real retirement plan for a 62-year-old retiring today with $625,000 saved. We'll set up the whole plan, every account, every phase and social security decision, and then we're going to run it through 6 completely different retirement strategies simultaneously. The 4% rule, variable percentage withdrawal, the 3-bucket strategy, floor and upside, Guyton Klinger guardrails, and a Monte Carlo simulation with hundreds of random market scenarios. If the plan holds up across all 6, you can retire with a level of confidence that picking just one strategy never gives you. Let's build it. First, let's meet our retiree. He's single, 62 years old, and is retiring today. No pension, just savings and social security. This is an incredibly common situation, and it's one where good planning really matters. I'm going to walk through every input so you understand what each one does and why I chose these numbers. So our plan is going to start at the age of 62 and it's going to end at the age of 90. That's a 28-year retirement. If you're planning to age 85 and you make it to 93, you have a problem. I'd rather plan long and finish with money left over. Now, the portfolio. This is $625,000 split across 4 account types, and the split matters just as much as the total. In the 401k, we have $350,000. This is the core account. Pre-tax, gross, tax deferred, taxable when you withdraw. Growth rate is set to 7%, a reasonable long-term assumption for a diversified stock-heavy portfolio. We have a Roth IRA of $130,000. We're going to assume the same 7% growth, but completely tax-free in retirement. We'll see why this Roth balance is strategically important in a minute. We have cash savings of $65,000, high yield savings or money market earning approximately 3.5, so anywhere between 3.2, 3.75, maybe even 4% right now. This is your near-term safety net. And in our equity and brokerage account, we have $80,000. Taxable investment account growing at 8%. This gives us flexibility. Long-term capital gains rates are more favorable than ordinary income. So our total portfolio, $625,000. Not a massive nest egg, but watch what happens when it's properly structured. Social Security is going to be claimed at the age of 67 and the amount we receive at 67 will be $2,800. That's full retirement age. This person has waited 5 years to claim instead of taking it early at 62. That decision alone is worth tens of thousands of dollars over a lifetime, and we'll look at exactly how much in the Social Security Optimizer tab. Notice there's no pension, no spouse. This plan has to stand entirely on its own. Now the withdrawal strategy. I've set up 4 phases, each representing a different chapter of retirement. In phase 2 and phase 3, we are keeping the withdrawal strategy exactly the same. This is the bridge period. Social Security hasn't started yet, so everything comes from the portfolio. I'm taking $2,800 from the 401k, $600 from cash, and $400 from the brokerage account. A total of $3,800 a month. That's modest, intentionally so. We're preserving the portfolio while we wait for Social Security to kick in. In phase 3, active retirement, Social Security starts at $2,800 a month. The portfolio only needs to add $1,200 from the 401k and $200 from the cash. Total monthly income jumps significantly, and the portfolio barely has to work. Actually, I want to extend this to the age of 78 for this scenario. Let's go in and do that here. So in version 5 we can update the phase boundaries here, so let's set that to 78. And now we can see that this phase goes from age 67 to 78, which is 132 months, and then our final phase will start at 78 and go to 90. So in the final phase, Social Security is still running, cost of living adjustments, so it's actually worth more in real terms at this point. So as we look at Social Security here, 3,194 as an average over this time period, and as an average in this time period we've got 4,293. That's just the effect of inflation. The 401k contributes $800 a month, and the equity account contributes $1,500. That higher equity withdrawal smooths the income, so later life spending stays comfortable rather than dropping off. Total portfolio contribution $2,300 a month. Now let's see what this actually looks like in practice. So we're now in the Overview tab, and this is the control panel for the whole plan. Each card represents one phase of retirement. The income breakdown, where the money comes from, and what's left in the portfolio at the end of that phase. These are the ending balances at each phase of the portfolio. So phase 1, you can see the monthly income figure, the breakdown between 401k, cash and equity withdrawals, and this is important, the healthcare cost. At this income level in phase 1, this retiree qualifies for meaningful ACA subsidies. The planner calculates that automatically based on income relative to the federal poverty level. This is one of the hidden advantages of retiring at 62 with moderate income. You're in a sweet spot for healthcare assistance. So now looking at the next phase, this is where the plan really opens up. Social Security activates here in phase 4. Look at how the income composition shifts. Guaranteed income goes from 0 to being the majority of monthly cash flow. That shift from portfolio dependent to floor supported is the whole game in retirement planning. Healthcare switches to Medicare here as well. Predictable, reliable, and the planner accounts for Part B premiums. Actually, that happens here in phase 2 also. In our next phase, our last phase, this is actually the longest phase. This lasts for 12 years. The equity withdrawal has been bumped up to smooth the income curve. You'll notice total income is actually slightly higher than the previous phase in gross terms. That's by design, because later life spending on healthcare tends to increase even as leisure spending decreases. Down here in the ending balances, you can see what each account looks like at the end of the plan. The portfolio doesn't go to zero. That's a meaningful residual. That's not a mistake. That's a margin of safety. The plan isn't designed to spend every last dollar. It's designed to give you confidence that you won't run out. See these pills next to the Social Security amounts? That's the cost of living adjustment. The planner applies annual inflation to your Social Security, so you're seeing what it's actually worth in later phases, not just the starting number. By the final phase, your $2,800 Social Security is worth meaningfully more in nominal terms. Let's talk about the most impactful single decision in this entire retirement plan, and that's when to claim Social Security. This tab is the Social Security Optimizer, and it answers one question: how much does claiming age actually matter over a lifetime? Here's where you can see the break-even analysis. If you claim at 62 versus 67, you get 5 years of lower payments earlier, but then you receive less every month for the rest of your life. The crossover point, the age where delaying starts to pay off, is typically in the mid-70s. But here's what the chart really shows. If you make it to 85, 90 or beyond, and a 62-year-old today has a meaningful probability of that, the delayed claimer wins by a very large margin. Social Security is longevity insurance as much as it is retirement income. Our plan claims at 67, full retirement age at $2,800 a month. That's the middle path, not the maximum possible at 70, but a full 5 years of additional accrual versus the early reduced benefit at 62. You can see the optimizer quantifying exactly what that choice is worth. If this person had claimed at 62 instead, the monthly benefit would be significantly lower for every single month for the rest of their life. That lower floor makes every other strategy in this plan harder to execute. The Social Security decision isn't just about monthly income. It's about the structural foundation your whole plan sits on. Let's take a look at the Scenarios tab. The Scenarios tab lets you test the same plan under different market assumptions. What if your 401k averages 5% instead of 7%? What if you get 9%? Does your plan survive the range? You're looking at 3 scenarios simultaneously: conservative, base case, and optimistic. The key thing to look at here are the ending portfolio balances and the income figures across each phase. Notice how the income numbers don't change as dramatically as you might expect between scenarios. That's the power of having a large guaranteed floor. Social Security doesn't care what the stock market does. In a terrible market, the portfolio suffers, but the guaranteed income doesn't move. The plan has a built-in shock absorber. This is resilience through income architecture. The plan doesn't rely on getting the growth rate exactly right. It relies on building a foundation that markets independence, with the portfolio as a complement rather than a sole engine. Let's take a look at the Chart tab. The Chart tab shows the cumulative portfolio balance over time, a visual for how the accounts evolve across all three phases. You can see the portfolio declining in phase 1 as the bridge withdrawals come out, then stabilizing significantly once Social Security kicks in at 67. The slope of decline flattens dramatically, and in later phases the portfolio is doing far less work. It's not running out, it's coasting. The equity account in particular has time to compound. We're not touching it. That 8% growth over 11 years turns the 80,000 in equity balance into a much larger number, which is exactly why we can afford the higher 1,500 a month equity withdrawal in the final phase without depleting the account. Let's take a look at the stress test tab. Now we're going to start deliberately breaking things down. The stress test tab takes the plan and asks what happens in the worst realistic scenarios. You can see scenarios here covering a significantly early market drawdown. Here we are with the bear market at -3%, and we can also see a scenario which is more optimistic with +3%. Just look what the floor does. Even in the stress test scenarios that hurt the portfolio, the moment Social Security activates at 67, the income picture stabilizes. The guaranteed floor provides a recovery mechanism that pure portfolio withdrawal strategies simply don't have. The plan survives the stress tests, not comfortably in every scenario. Some of them show reduced late life balances, but the income floor remains intact throughout. That's the definition of a resilient retirement plan. And now the section I've been building towards. This is the Drawdown Strategies tab, and it's where this planner does something I haven't seen other retirement tools do. Rather than committing to one withdrawal methodology, we're going to run all 6 of the most widely used strategies against this exact plan. Same portfolio, same Social Security, same phase structure, 6 completely independent lenses. At the top you can see the plan summary the strategies are working from. Total portfolio, guaranteed floor, blended growth rate, and planning horizon. Let's go through each one. The 4% rule. This is the one most people have heard of. The Bengen and Trinity study finding that withdrawing 4% of your portfolio in year 1, then adjusting for inflation, historically survived 30-year retirements over 95% of the time. Here's our result. At 4%, the monthly portfolio withdrawal is $2,083. Add the $2,800 Social Security floor, and the monthly income is $4,883. Our plan averages roughly $3,400 a month net, so the 4% rule says we could be spending more than we actually are. The plan is inside the safe zone. If we look at the insights, it actually says the 4% rule suggests you could spend $688 more than your current plan. You may be planning conservatively. Consider whether increasing discretionary spending in early phases or accelerating Roth conversions makes sense. Let's have a look at variable percentage. This is more sophisticated than the 4% rule. In one important way, it recalculates your withdrawal every single year based on your remaining balance and remaining years. So it's self-correcting. The way it works: you use a conservative assumed return, in this case 5.5% versus the portfolio's actual 7%, which creates a built-in cushion. Because the portfolio grows faster than the conservative assumption, the surplus gets released as rising income over time. Let's look at these cards. Income at age 62 is around $6,500 a month. Income at 76 is higher, and income at 90 higher still. Unlike the 4% rule, which locks in a fixed amount, VPW gives you more to spend as you age. Some people find this counterintuitive. Isn't this the period when you want less? But consider, healthcare costs rise, care needs rise, and the portfolio should be helping with that, not stubbornly withdrawing the same inflation-adjusted amount from 1995. VPW income exceeds our plan throughout retirement. Another green result, and this one shows income growth rather than just survival. Now let's take a look at the 3 buckets strategy. This is less about math and more about behavior and psychology, and that matters enormously in real retirement. Bucket 1 is cash, and that covers the next 3 years of portfolio withdrawals. You never touch bucket 2 or 3 for day-to-day living. Bucket 2 is your Roth IRA in balanced or moderate growth allocations. It covers years 4 through 10, refills bucket 1 each year. And bucket 3 is your 401k and equity, 100% growth allocation, untouched for the first 10 years, refills bucket 2 from year 11 onwards. The genius of this approach is simple. When markets crash 30% in year 3, you don't sell a single share of stock. You draw from cash, you give buckets 2 and 3 time to recover, you never make a fear-driven decision with a permanent impact. Our portfolio is exactly sized for this strategy. Cash at $65,000, that's 156% of the bucket 1 target. Roth at $130,000, that's 245% of bucket 2 target. And the 401k plus equity at $430,000, maybe a little more, against a bucket 3 target of $300,000. So all 3 are marked as fully funded. The overall portfolio is funded at 133% of what the bucket strategy requires. This portfolio isn't just surviving the strategy, it has substantial room to absorb a worse than expected market without touching growth assets. So there's another green check mark for our overall plan. The next area we're going to look at is the floor and upside area. And this is the most philosophically aligned strategy with how this plan is actually built. It divides income into 2 tiers, a guaranteed floor that nothing can touch, and portfolio funded upside that grows with the market. The floor here is $2,800 a month in Social Security. That's money that will arrive every month regardless of what the stock market does, what interest rates do, or what happens to the global economy. It's guaranteed by the US government and fixed to inflation. The key metric is the converge ratio. What percentage of your average monthly income comes from that guaranteed floor? Now this says 67% floor coverage, and this number represents something very powerful. 67 cents out of every dollar this person spends in retirement is guaranteed. Only the remainder requires the portfolio to cooperate. Above 60% is the green threshold. Above 80% is exceptional. This plan sits at 67% because the portfolio is conservatively sized. The Social Security floor represents the dominant income source. Phase 1, before Social Security starts, shows 0% floor coverage. That's real. That's the genuine vulnerability of the bridge years. But later, the coverage is consistently high. The plan gets stronger over time, not weaker. Portfolio surplus is $206,000, above what's needed to sustainably fund the gap. This isn't a plan that's exactly sufficient. It has genuine margin, so there's another green check mark that shows our plan is on track and we can have a great deal of confidence. The next section I would like to look at is the Guyton-Klinger Guardrails section. This starts at a 5% withdrawal rate, which is higher than the 4% rule, and uses a dynamic adjustment mechanism to keep the portfolio on track. Here's how it works. If the portfolio performs badly and the effective withdrawal rate climbs above 6%, you voluntarily cut spending by 10%. If the portfolio performs well and the rate drops below 4%, you raise spending by 10%. It's a rule-based system that responds to reality rather than ignoring it. You're looking at 3 scenarios simultaneously: a bull, base case, and bear market. In the bull scenario, the guardrail system raises your spending. In the bear scenario, it triggers a cut. Now look at the income cut figure. After a 10% guardrail cut, monthly income is still $5,144. That's against a plan average of about $3,400. Even in the worst guardrail outcome, take a look at the insights and recommendations section. And finally, the Monte Carlo simulation. This is the gold standard of retirement stress testing. Rather than assuming any single growth rate, Monte Carlo runs hundreds of randomly generated market scenarios: good years, bad years, crashes, booms, combinations you'd never think to model manually. Each line on this chart is one possible future. Some portfolios grow dramatically, some decline sharply. The majority cluster in the middle. The question we are asking: what percentage of these random futures end with the portfolio still intact? The success rate for this plan is high. It actually says probability of being solvent at 90, 100%. That means out of all the randomly generated market scenarios, nearly all of them result in the portfolio surviving through age 90. To put that into context, a 90% success rate is typically considered a strong result. A 95% result is considered exceptional. This plan sits at the top end of that range because the portfolio is only being asked to cover the portion of spending that the floor doesn't already guarantee. Look at the spread of outcomes at age 90. Even in the scenarios where markets underperform, the floor income meets the portfolio was never the sole source of support. It was always a supplement to guaranteed income. The Monte Carlo is testing the portfolio. The floor is protecting against the worst of those tests mattering. One quick look at the tax and ACA notes section before we wrap up. This tab shows the tax situation for each phase: federal income tax, ACA calculation, Medicare, and IRMA thresholds. Phase 1 is particularly interesting. At this income level, from all portfolio withdrawals, no Social Security yet, this retiree sits below 400% of the federal poverty level, which is the ACA subsidy threshold. That means healthcare premiums are significantly subsidized during the most expensive years of private coverage. That's not an accident, it's a feature of thoughtful withdrawal structuring. In later phases, the tax situation shifts as Social Security activates and more income becomes taxable. But by then, Medicare provides stable, predictable healthcare costs. The plan accounts for Part B premiums automatically. So let's come back to where we started. 6 strategies, 6 independent stress tests, 1 portfolio. The 4% rule says this plan is spending $688 a month less than the safe withdrawal rate allows. VPW shows income that raises over a lifetime rather than staying flat. The 3-bucket approach is overfunded in all 3 buckets. The floor and upside strategy shows 67% of income is guaranteed. Guardrails generate more income than the plan needs, even after a bear market cut. And Monte Carlo puts the success rate of this plan at 100% across hundreds of random scenarios. This is what confidence looks like in retirement planning. Not certainty. Markets are never certain. not perfection. No plan ever survives contact with the future unchanged, but alignment. Every methodology, every angle of analysis pointing in the same direction. The keys to getting here were straightforward and they're available to anyone. 1. For this particular plan, delay Social Security. Even 5 years changes the entire structure of the plan. The floor you build here works for you for 20 or 30 years, and it's particularly important in a scenario where you are planning to age 90 or beyond. 2. Diversify accounts, not just investments. 401k, Roth serve different tax functions. Cash and equity behave differently in a downturn. The bucket structure only works if the buckets actually contain the right things. 3. Plan conservatively in the portfolio, generously in the timeline. This portfolio assumes 7% returns. Historical averages are higher. The plan is designed to survive underperformance, not depend on outperformance. And 4. Let the floor do the heavy lifting. Every dollar of guaranteed income is a dollar the portfolio doesn't have to produce under pressure. Build the floor first, then size the portfolio to complement it. The planner I've used throughout this video is available at webnomadstudio.etsy.com. It runs entirely in your browser, nothing to install, no subscription. You can enter your own numbers and run the same 6-strategy analysis on your own plan today. If this was useful, subscribe. I'll be walking through more scenarios. What changes if you retire at 55? What happens if you have a pension? How to structure a couple's plan with 2 different claiming ages. And if you've already retired or you're close, drop your biggest planning question in the comments. The best future videos will come from the questions that you ask. Thanks for watching. Plan well, retire confidently, and I'll see you in the next video.